a picture of the screen?
I've got it.
Okay.
Yep.
My name's Kip Bishop. The name of my company is Senior Mortgage Solutions, Inc. I actually have been doing mortgages since 1978. That kind of gives you an idea how old I am, and I'd appreciate if y'all would kind of keep it a secret. But the fact is that I've been doing reverse mortgages since 2006. And when I started with reverse mortgages, it was something that was hard to find information on. The internet really hadn't picked up on the reverse mortgage market. If you'll go to the next screen on this one, reverse mortgages are a basic reverse mortgage is a HECM program, which is a government-backed lending program that allows homeowners to access the equity in their homes without selling the home or without having to get a forward mortgage that requires them to make payments while they're still living in the home. The nice part about a reverse mortgage is it actually gives you an opportunity to tap those funds and not make a payment if you choose not to. Now, the caveat to that is that you do not have to make a mortgage payment, but you still have to make the tax payment, the insurance payment, and the maintenance on the home. Okay, any questions about that? Okay, there's also a program called a reverse mortgage that is proprietary, or it's a private reverse mortgage program. And frankly, the way that that works is it's just like the HECM, other than government FHA programs don't have, they're not limited like the government program. You can go with higher lending limits. You have a different mortgage insurance requirement. And on condos that otherwise don't fit FHA, you can get those done through the Advantage program. We're going to talk about the basics of a reverse mortgage. Go ahead and go to the next one. What is a reverse mortgage? What the benefits of having a reverse mortgage are, the types of reverse mortgages that are out there, how you qualify, some of the common myths that you hear all the time about reverse mortgages. We'll get those squared away today. And then the risks of a reverse mortgage, because like every financial product, it's not without some risk. And then the process of going through to get that reverse mortgage. Go on to the next one. The first question is, what is reverse mortgage? And simply stated, it's access to existing equity. Rate repayment is not required while the owners live in the property. And the reason this is so popular is that Americans hold over $18.7 trillion in personal real estate equity. In fact, most of us have most of our family assets tied up in our homes. And the problem has been quality of life and how do you access those dollars. So some of the alternatives would be liquidating the asset or selling your property. Now the question becomes, where do you go? Where do you live? And where do you generate the cash flow to repay the debt? With a reverse mortgage, your obligation is you must continue to pay the taxes. You must maintain homeowner's insurance on the property, so if it burns down, it can be replaced. And you have to maintain the property so that it doesn't fall into disrepair. You do those three things, and frankly, you can stay in the property until you pass, until you decide not to live there, or until you sell it. Some of the benefits, and you go on to the next, some of the benefits that we're talking about is that we are going to be able to eliminate the current mortgage payment that you have. So if you currently have a balance on your mortgage, By doing a reverse mortgage, we're going to pay off the first mortgage that you have and replace it with a reverse mortgage. We can actually eliminate foreclosure. So if you know someone who is struggling to make those payments because of a fixed income, we can replace the existing mortgage with that reverse mortgage. In doing so, we can actually pull it out of a foreclosure. So even if foreclosure has already started as a process, we can stop that and bring it back into compliance. And if you have other assets, let's say you have a 401k, a pension, other assets that are there, we can actually use a reverse mortgage to hedge against any economic downturn. Now, by that, what I mean is, let's say that you have your funds in the stock market and suddenly there's an adjustment, which we seem to have every 3 to 4 years, and the market starts to decline. The fact is if you took your money out at the bottom of the market, you actually never have a chance to recover those dollars because you took them out at the low end of the marketplace. And as the market recovers, you don't get the benefit of that recovery. Instead of pulling your dollars out at the bottom of the market, what you can do with a reverse mortgage is, if you have your line of credit in the reverse mortgage already established, you can actually draw from the line of credit, use those dollars and leave the other dollars in your investments. When those investments recover, you actually are going to extend the amount of time that you have to use those dollars into the future. For most of us, the amount of the equity that you're allowed to pull out of the house, including what you use to pay off the mortgage, is about 50%. It's usually a little higher than that, but just for the sake of argument, let's say that it's 50%. So if you have $100,000 in equity in the property and the property's worth, say, $250,000, you will be working with $125,000 and then using that $100,000 to pay off the mortgage and having an additional $25,000 that you can take and use for any purpose. So let's go to the next one. The benefits of the reverse mortgage: it protects your family's assets from Medicaid. Now, most people don't know this, but if you had a catastrophic health event, a stroke, a heart attack, something of that nature, and you were already set up in a reverse mortgage, the fact is that when you go into medical needs, now most of us, with VA, we have VA benefits, but let's say it's a spouse and they have Medicare, and over time they have to have long-term recovery. They have to have oh gosh, I'm searching for the word, rehab. When you are, or if you know someone who needs long-term rehab, Medicare has a day limit. You can only go about 110 days in rehab, at which point they then turn off the rehab for Medicare, and you have to go to Medicaid in order to continue that. What a lot of people don't understand is when that occurs, it is a means-tested program, which means that they make you sell your assets. They give you, out of all of your income, a set dollar amount, usually about $2,000, $2,100 a month that you can spend, and the rest of it goes to Medicaid. Also, when you're on Medicaid, if you qualify for that program, at the end of life, what has happened is Medicaid then puts a lien on your asset, on the house. And when you die, that asset doesn't go to your heirs. It first goes to Medicaid to repay the debt. When you have a reverse mortgage in advance of that event occurring, they can't do that because there's already a lien on the property. And Medicaid cannot put a secondary lien against the property. And that then protects that property when you pass. Your heirs actually get the excess equity sitting in that house because Medicaid can't touch it. So let's go to the next benefit. A reverse mortgage protects your family's assets from Medicaid. The unused portion of the line of credit actually grows. So let's say that we have paid off your first. You have a line of credit of, say, $100,000, and you're not using it. It's simply sitting there. When it's sitting there and you're not drawing on it, it actually earns the same at the same rate as the interest that you would be paying on the mortgage if you were borrowing it from yourself, plus the mortgage insurance. So if the rate is 3.5 and the mortgage insurance is 0.5, that means it's earning at 4%. Your line of credit is actually going to grow year to year, compounded daily at 4%. So the next year, it's not a $100,000 line of credit, it's actually $104,000 plus interest. So let's talk about qualifying for a reverse mortgage. Here are the things that you need to know. A borrower must be living at the time of the application and at the time that the loan's approved. The property must be titled in the borrower's names. So if you're married and both of you are going to make the loan, that's fine, but it's not absolutely necessary. There must be sufficient equity in the property. So if you if the house is worth 100,000 and you owe 98,000, we're not going to be able to do a reverse mortgage. So it's, like I said, it's about 50% of the value of the house is what we're looking for in the equity. The property has to be in good repair because we're going to do an appraisal. It is an FHA program, which means that they can walk in and they can look at some things and say that repairs have to be made. Now, the most common thing that I run into is in a kitchen area, you may have an electric plug near a sink. It requires a CFI. And if the appraiser comes in and sees that it's not a CFI, it has to be repaired or replaced before they'll make that loan. A good loan officer, whoever it is, would be able to tell you that before an appraisal is ordered and walk through the property and point out the things that need to be modified. It's not unreasonable, but they do want the property be in good repair. The youngest borrower on this program has to be at least 62 years old. Now, it's possible to do a loan with one of the spouses being less than 62, but there are some things that happen with that it means they would not have access to the line of credit if something should happen to the primary borrower. So they'd actually have to refinance the property if they were going to stay and wanted to access the line of credit. Now, if the younger borrower is not on the loan and the borrower dies and there's a reverse mortgage, the younger borrower, the spouse, is able to stay in the house without penalty. So they're not going to be kicked out of the house. They're not going to force a sale that leaves one of the spouses without a place to live. And that's a concern that a lot of people have. The borrower is actually living in the home is absolutely a requirement. And credit is not an issue, but it is required. In other words, we have to run a credit report because we're not looking for your score. What we're really looking for is, are you willing and have you shown an ability to pay your bills? That's it. Other than that, we really don't care. The only income requirement that we're looking at is, do you have enough money to pay the taxes and the insurance and the maintenance on the property? Usually Social Security is sufficient to cover that. But that's the only income requirement that we're looking for as well. Unlike, and does anybody have a VA loan? On a VA loan, it's just like a regular loan, except that we are guaranteeing, the feds are guaranteeing the bank that they won't take a loss if you're unable to stay in the house. But they are still going to look at your credit worthiness, they're going to look at your assets, and they're going to make a credit decision as to whether or not you're able to get that loan. With a reverse mortgage, none of that comes into play. It's just enough money to pay the maintenance, the insurance, and the taxes. So let's talk about personalized structure. There are more than one way to do a reverse mortgage. You can actually set it up as a tenure. So what happens with tenure is they are saying, look, you have X numbers of dollars, and we are going to give you, like an annuity, a certain amount of money every month for as long as you live, no matter how long you live. Now, because they are looking at actuarial tables and they're looking at a fixed amount of money coming out of your equity, sometimes tenure tends to put you in a situation where you're not getting as many dollars as you would hope on a month-to-month basis. So you have to be careful. There has to be enough equity there to make it worthwhile. But I've seen situations where $300 or $400 a month is all a family needs in order to make ends meet, and that would be a good way of doing it, to ensure that that amount of money is always there. There's also term, which borrowers receive a fixed amount of money or of cash for a fixed length of time. So now, instead of being for the rest of your life, they're saying you'll get a fixed amount of money for 5 years or 10 years or 20 years. And between you and the lender, they will help you decide whether, through the actuarial tables, whether the expectation is that you live that long or longer. And what happens at the end of that time is you would no longer be getting any funds out of the mortgage, but you would still be allowed to live in the property as long as you live. You just wouldn't have the benefit of those extra dollars. The next one is the line of credit. Now, I will tell you that in my experience, this is probably the best way to access funds through your property, because a lot of people don't have a specific need that they can point at, and they need all of that cash out up front. They don't need all the cash. What they need is an emergency till where they can reach in whenever they need it, pull it out, and use it. And by the way, when you have a line of credit, while you are not required to pay the to make a payment on your mortgage, you certainly may make a payment on your mortgage and put those dollars back into your line of credit, where they will be held in your line of credit, and those dollars will also grow on an ongoing basis. So if you have the ability to repay, that's a good thing, but it's not required. Then there's the modified tenure. It's a combination of taking a cash amount and having a line of credit. or a modified term where you are taking a lump sum at the beginning, but there's enough equity for you to get additional dollars on a month-to-month basis. So it's a very flexible program that allows you to structure the loan to meet your specific needs. So what I'd like to do is just show you a sample reverse mortgage on the next slide. Let's say that your home value is $200,000. And guys, I know that $200,000 isn't even a down payment in Colorado anymore, but let's say that the home value is $200,000 and there's an existing $80,000 mortgage on that loan. So the way a program would work for, say, a line of credit, on the next slide, I have a pie chart that shows you that the purple at the bottom is how much has to be paid off on the existing mortgage, because we're going to pay off the old mortgage and we're going to put you into a new reverse mortgage. Then to the right of that, you'll see that the insurance fees are about $5,000 in this example, and that the finance fees are another $4,000, and that includes your appraisal, your title costs, everything else to make the loan. Then to the left in the green, you'll see your line of credit. That, in this example, it would be $19,400 line of credit after paying off the mortgage and paying the cost of the loan. That gray box that you see at the top, that is called equity reserve. And basically what it says is those are the dollars in the equity of the house that are going to stay with the house. And neither you nor we as the lender are going to have access to those dollars. Now, what's interesting about this is, let's say that in 5 years, the value of the house is not $200,000, but it's $300,000. Now your equity reserve is actually $191,000, $191,600. And those are excess dollars that if you want to access it, all you have to do is we simply go back in and we refinance the reverse mortgage, and the process starts over again. So now you have a mortgage payoff that would be the amount of the reverse mortgage that you currently have, including the interest that has accrued since the last time you refinanced. Pay that off. They would hold a certain percentage of that as new equity reserve, and they would reestablish a new line of credit. Generally, good lenders will do that. It won't be free of cost, but they will reduce a lot of the costs to numbers that make it well worthwhile doing that.
In this particular case, what is the interest rate you mentioned?
Say that again?
In this particular case, what is the interest rate that you referenced?
In this one, we're working off of 4.5%.
Okay, and the equity reserve is remaining in the name of the owners, correct?
Absolutely. In fact, as we move forward, we'll hit some of the things that a lot of people are concerned about with the ownership of the house. And I'm glad you brought it up, because the first thing right off the bat is most people believe that they no longer own their house. But let me ask you a question. If you do a VA loan or a 30-year fixed loan, do you still own your house?
Correct.
And the answer is yes, you do. The only thing that happens is there's now a lien on the house where the bank you've pledged the house against the debt.
Correct.
That's exactly what happens with a reverse mortgage. So if we go to the next slide, you'll see that your question is the very first question I have is, do I still own my home? Yes, you do. And the fact that a lot of people believe that you don't is completely false. Okay?
Got it.
The next one is reverse mortgages are too expensive. Let me explain where the expense of a reverse mortgage is. And let's go to the next one. I'm sorry, leave it right there. The fact is the expense of a reverse mortgage happens because there is mortgage insurance involved. And the mortgage insurance represents 2% of the value of the house. So if the house is worth $200,000, the mortgage insurance will be $4,000 up front. Now that does not come out of the pocket of the borrower, but it does come out of the equity. Does that make sense? So you're not writing a check for the $4,000. It goes into the closing costs, and we roll that into the payoff for your existing mortgage. And those dollars are now part of the mortgage insurance, or I'm sorry, they're now part of the balance of the loan. But the fact is that that is a one-time fee, and then on an ongoing basis, you're paying 0.5% of the balance of the loan on an ongoing basis. The benefit of that is it's going to guarantee that the loan is a non-recourse loan. In other words, at no point, let's say that the value of the house suddenly drops, and now you owe more than the house is actually worth. No one is going to call and make a demand that you pay the difference or that you move out of the property. Also, at the end of life, or at the end of the time that you live in the property, there will never be a situation where you're expected to pay any shortage where the value is different than what you borrowed. And that includes your heirs. And also, one of the other benefits is when you get to the end of the reverse mortgage and the house is sold, if you owe $100,000 on the reverse mortgage, it's actually settled for 95% of that value, or 95,000, not the 100,000. All of those things are benefits that you are actually paying for when you are paying mortgage insurance. Now, if you said, well, I don't want any of that, then the answer is because FHA said so. Okay? Now, the next question is, can I outlive my reverse mortgage? And the answer to that is no, you can't. As long as you live, you have a right to live in that property. As long as you pay the taxes and the insurance and maintain the property. Okay? Now, the next question is, if I die, my spouse will have to sell the house and move? And the answer is no. Whether the spouse is on the mortgage or not, as long as we know that the spouse at the time that the loan was taken out is not on the loan, she does not have to move out of the property, or he does not have to move out of the property. So the spouse is protected. Now, I will tell you that 15 years ago, that was not the case. If only one of the two spouses was on the mortgage and that spouse died, then the surviving spouse did have to move out of the house and the property was sold. But we fixed that through the program that that's no longer the case. The next thing is, do I have to pay taxes on the proceeds I receive from my reverse mortgage? The answer to that is no. Because what you're getting from the equity of your house is not income. You took out a debt instrument in order to access those dollars. And even if you take those dollars over time, that is not seen for tax purposes as income. That is debt. And they will not tax debt, only income. That's also the reason that when you, if one of the two of you are actually looking to Medicaid, it's important to remember that since that's a means-tested program, Medicaid is looking at your income in order to measure whether or not you qualify for Medicaid. A reverse mortgage, even if you have a line of credit sitting there, they cannot force you to use that line of credit for your medical expenses. Because again, it's not income, it's debt. And so those dollars are exempted from the Medicaid calculations. Now, the caveat to that is Medicaid does have a rule that gives them the right to go back 5 years on a look back. And so it's important that if you're doing planning for the future, that you know that you can set up that line of credit and 5 years from that date, after that, Medicaid can't go back and force you to undo any of that. Okay, the next one is, I'm adding debt I can never repay. The point of a reverse mortgage is, yes, you can repay it. You don't have to repay it. As I said, you have to pay the taxes, and you have to pay the insurance, and you have to maintain the property, but you don't have to repay the dollars that you've actually borrowed. We are not looking to the individual for repayment of the debt. That's the reason credit's not a critical issue. What we're looking at is we're looking at the ability of the property to repay the debt. So when you move out of the property, or you stop living in the property, or both parties have passed away, then the property is sold through your estate, and the debt is paid from the proceeds of that sale. And then any additional dollars that are sitting there, so let's say you paid the $100,000 that you owed on the reverse mortgage, but now there's an extra $100,000 that's sitting there, that goes back into your estate and it's disposed of as you have outlined in your will. And that's a distinction that I think is a lot of people miss, is that your heirs still have access to your asset through that house. And that's a big deal with me. So on the next one, we're talking about heirs won't inherit anything, and there we are. The fact is that we are only putting, at the time of the loan, we're only putting about 50 to 60% of the value of the equity into the reverse mortgage. Over time, the value of the house is increasing, as it always seems to. So the value of the house is worth more. Yes, what you owe is going up because you're not making a payment, but you are accruing the interest rate on the loan. So that's going up. But between the two of them over time, there is additional equity that's growing. And that equity stays with the house. And so when you pay off, or the house is used to pay off the debt, anything that's left goes to your heirs. The next one is that funds can only be used for specific expenses. No, that's not true. You can use the reverse mortgage for any purpose whatsoever, anything you choose. You can even use the proceeds of your reverse mortgage to pay the taxes, the maintenance, and the insurance on the house. And remember that any of that line of credit that's sitting there, let's, for argument's sake, say that was the $100,000 in the line of credit, and that you are not using those, that means at the end of the year, if it's growing at 4%, there's $4,000 that's sitting there. If you need to borrow that $4,000 to pay the taxes, you can do that. In the meantime, if you have a new boyfriend or girlfriend and you want to take a cruise with it, nobody's going to tell you you can't do it. Just remember that your line of credit is finite. There's only so many dollars that are there, and you'll know what they are, that you can access. And when those are gone, the only way to access more is to refinance the loan, which adds expense to the loan. But it still can be done. So let's talk a little bit about the risks of the reverse mortgage. And I just touched on it. It kind of gives you a false sense of security sometimes. You think, oh my gosh, I've got $100,000 sitting there that I can access for any reason that I want to. And I've had people who have gone out and in 2 or 3 years have spent every nickel of that, and it's on things that don't matter. The only way, again, to access additional dollars is you have to have enough equity there that we can pay off the existing mortgage and start the whole process over. But it can be done. Also, remember that this is not a substitute for the savings that you have for retirement or that people have had for retirement. This is just one more piece that gives you some security that otherwise you might not have. So, you know, if you're still putting dollars away in savings for retirement, you still need to do that. And then, of course, there's the moral hazard of, you know, you have access to large sums of cash, and sometimes, and this happens with a lot of families, it's hard to say no to yourself or to family members when they come to you and say, well, I need X, Y, Z, and I promise I'm going to pay that back. Sometimes we need to learn to say no. And that can be hard when they know that you have taken out a reverse mortgage and you have a line of credit sitting there. And I'm not telling you, don't tell family that you have it, but I am telling you to be very cautious about how you spend it. So if someone is interested in a reverse mortgage, it's a pretty simple process. You get with anybody who does reverse mortgages that knows their business. My suggestion, and there was a time when I was just getting into reverse mortgages and I didn't know anything other than the fact I thought it was a magic bullet. And, it would have broken my heart had somebody said, no, I'm not going to work with you because you don't know enough. But you do need to interview the people that you're working with to make certain that they know how the reverse mortgage process works and what kinds of programs are in your best interests. Every one of us will do the very best we can to ask you the questions that we need to get answers to figure out how we will benefit you the best. Once we have designed the program that fits you, then you're going to be required, and this is a federal requirement, you have to take counseling. And I notice I misspelled counseling, but you are going to be required to take counseling from an independent third party. And when you've completed that, they're going to give you a certificate of completion. Now, because we've helped you design the program that you should be interested in, the counselors are going to ask us to send that to them before they counsel you to make certain that we're giving you all of the facts, that we haven't lied to you by omission or overtly, that we've told you everything you need to know about this program. And then once you have that certificate, you will come back and we'll do a complete application for the reverse loan. And then we underwrite it just like a forward mortgage, a 30 or 15-year mortgage, except again, we're not as concerned with credit or with your income or with your assets. But we then have that program that we helped you design, and we put that to the lender, and the lender makes the decision to make the loan. And at that point, we close the loan. It's not much more difficult than what you would go through if you were doing a forward mortgage. So literally, that's the program. What I'd like to do is I'm going to open this up to all of you for questions. By the way, I also do VA loans and 15-year and 30-year forward loans, including FHAs. I'm happy to talk and answer those questions as well. But the one thing I want to make absolutely certain of is to let you know that I'm not here selling a reverse mortgage or any other type of mortgage to you. My job literally is to give you the information and help you find sources so you can make informed decisions, because a reverse mortgage isn't for everyone. Just like there are certain people out there, unfortunately, that they really shouldn't buy a house because they haven't got the maturity or the knowledge of how to do that in a way that benefits them. It just gets them into trouble. And it takes lending professionals at every level to help somebody navigate that. But at this point, let me just open it up, and I'm happy to answer any questions that I can.
Rich Devlin here. How you doing? Can you hear me?
I can. Can you hear me?
So, yep, I can. So, is the reverse mortgage only good for a home, or can it be used for a business that is paid off and is mortgage free? A building.
Yes, it's for single family up to a 4-family unit, just like an FHA loan is. It's not for a business,
Okay.
just for the residents.
Okay. That's all I need to know. Thank you.
You bet.
Kip, I'm going to go ahead and stop the screen share.
Okay.
So Kip, I have a question for you. So
Sure.
if the house appraises at $100,000, excuse me, $200,000, and you have $100,000 in equity, what happens if the economy tanks and the house is no longer valued, but maybe $130,000, and you already got this equity? I don't even know what you called it.
The line of credit.
The credit, yes. So what happens to that ratio? Is it staying the same?
It stays the same.
Okay.
So once the loan is made, it's a snapshot in time. So at the time that we close the loan, everything's perfect, and let's say there's a $50,000 line of credit. And the next month, the market completely falls out of the bottom falls out of the market. And now you actually, the house is worth less than the value of the line of credit and the money that we use to pay off the loan. At that point, congratulations, you're sitting on a line of credit, and there's nothing that the federal government is going to do to take that loan or to adjust it.
Okay, so at some point, the home is paid off, correct?
Well, the original loan on the house, let's say that the house is worth 200,000 and there was 50,000 that was still owed. So now we do a reverse mortgage, and let's say that we do 50% of the value of the house is equity. That's on a $200,000 home, you owed, I've kind of gotten lost in the numbers, but the point I'm making is that we used $50,000 to pay off the first, and then we took another $50,000 and we set up a line of credit on that $200,000 loan. So now there's $100,000 in equity reserves that stays with the house, and there is a reverse mortgage for $100,000 on the house, of which $50,000 is a line of credit that has not been used. So interest is only accruing on the $50,000 that we use to pay off the home.
Okay,
That
so
make sense?
is there an end point for the reverse mortgage?
Yes. When you stop living in the house, when you sell the house, or when you die.
And that's the only time,
Those are the only end dates.
okay?
Now,
And-
you may choose, you hit the lotto and you decide, okay, I'm going to pay off my reverse mortgage, and you can do that without penalty.
Okay,
And in fact, as I pointed out earlier, if you owed $100,000 on the reverse mortgage, you actually pay it off at $95,000, only 95% of the value.
right, okay. And I have one other question.
Yeah.
So if you have two people living together and they're significant others, but not by marriage, not by legal contract, and one person is on the house, but that other person has lived there 10, 15, 20 years, does that make a difference?
Yes, it must be a legal union. Now, it can be a marriage, or it can be common law, but it has to be documented, and we have to know that at the time of the loan.
Okay. Good to know. Thank you.
Yep.
Does anybody else have any questions?
Yeah, Kip, you came up with a 4.4% interest that would accumulate on the mortgage. Where
Right.
did you come up with that number? Is it always that, or can it change?
No, and I'm glad you asked. The loan for, when you do a line of credit, which you probably can hear it with me, I am a huge believer in the line of credit, because it continues to, that line of credit can continue to grow over time. But that is a variable rate mortgage. In other words, it's tied to the CMT, which, by the way, you can get the daily quotes of that in the Wall Street Journal or online, but that is your index. Then to that, there is a margin, and that margin varies from, and it varies at the time that we do the loan, but then it can only change once a year on the anniversary date. So I'm just using 4% as a, right now, I think most of my loans are coming in at 3.89 right now, but interest rates are trending up a bit. So I would say 4% is a fair number to look at. But you're really dealing with two numbers. It's the interest rate, which is the index and the margin added together. And then to that, you have to add the mortgage insurance, which is a half point always.
Okay, thank you. I was just wondering where you come up, because I figured, there are times you could take the whole thing out and invest it and possibly get 5 or 6%. So that's why I was questioning that.
Well, for ease of numbers, I could just as easily have said 10%, but then I wouldn't be standing here talking to myself,
Yeah,
because nobody would think that was a good deal. On the other side, I don't want to make it so low that everybody goes, oh my God, that's incredible. The fact is that on the 30 and 15-year loans, we're just under 3%. But that's trending up as well. The reverse mortgages aren't going to lead or trail that number very much. It's about the same as what you'd pay in the forward market.
okay,
For 30
thank
or
you,
50.
and thank you, and thank for all the info tonight.
You're very welcome. And guys, my contact information is there, not in order to do business with you, but if you have questions, even if it's just to say, hey, look, I'm talking to somebody and they told me X, Y, Z, and I'd just like to verify that information, feel free. I'm happy to do it.
So I have one more question, Kip. So when you were talking about Medicare and Medicaid and our spouses possibly going into long-term care, hospice care, and how Medicaid will come back for the payments to cover those expenses.
Right.
In the reverse mortgage, you say that they cannot do that. So is there an endpoint where they can come back, or is that just permanent? They cannot?
Well, if both spouses are on the reverse mortgage, the reverse mortgage is going to put a lien on the property, and that lien is going to represent a number that is 150% of the appraised value. So if the house is worth $100,000, they're going to put a lien on for $150,000. Okay? That's done to protect the borrowers from third parties who would like to put a lien in a second position on the house. Okay? It doesn't affect your credit as a borrower. But as long as both spouses are on that loan, they both enjoy the same protection against Medicaid or an unscrupulous third party who, is chasing ambulances and is going to try and sue you for slipping on your slippery sidewalk. It's not going to happen because there's no equity in the house for them to benefit from. It's protected. The only thing you have to be careful of is using a reverse mortgage to protect yourself legally that way. Medicaid has the ability to do a 5-year look back, so they can unravel that knot if it's less than 5 years. So I see a reverse mortgage as being a protective move as well as a good financial move. It's protective in that it gives you that legal protection against those third parties. But you
Right.
have to be planning ahead in order to take advantage of it. And so the answer to the question is no, there's no end to it because the property's protected.
So as long as there's the reverse mortgage in place, Medicaid cannot do anything.
Correct.
But now I'm talking about the opposite of that. So I hit the lotto and I want to pay off my reverse mortgage 2 years after my spouse passes. Can Medicaid come back
No,
at that time? Okay.
no. Now, if the spouse passes after you win the lotto and you've paid off the house, then yes, if you're still getting Medicaid, they'll hit you for that portion of the Medicaid since the time that you paid off the mortgage. Does that make sense?
I'm talking about paying off so if the mortgage is paid off and the reverse mortgage is paid off, is there a point where Medicaid can come back later on?
No,
So I'm protected as long as I have the reverse mortgage, but I'm not protected once I'm out of the reverse mortgage.
that's correct.
Okay.
But they can't come back, and they can only hit you for those dollars that have accrued to Medicaid since you paid off the house.
Okay,
Does that make sense? Is that answering the
Yeah.
question?
yes.
Yeah.
Thank you.
Yep.
Okay, any other questions?
One question to you, Chip, not Kip. This is being recorded and we
Yes.
can look at this at a later date or show it to someone else, correct?
Yes, actually, what we're doing is Pat has put something up on the Colorado Legion homepage. So there's a link out there and you can click on that link and it'll take you to the resources and information page. And you'll be able to download this information and share it with others, which we
Roger
highly
that.
encourage you to do.
Roger that. Thank you.
You're
And
welcome.
by the way, everyone, I have been asked if I would come to the mid-year convention or
Conference.
conference, and I will be there. And I'm more than happy to, take the time to answer any questions there as well.
So that's just another piece of this that we're doing is the folks that are working on these resource and information sessions from now through mid-year, they have all agreed to come to mid-year. So if you guys have any additional questions that come up between now and then, and as you're talking with other folks and maybe some friends and you might have additional questions, please, please, please bring them with you. And all of the presenters will be available to answer further questions. And if you need something, sooner, feel free to reach out to me or to Kip. His information is on the last slide, and you'll be able to, or I will be able to get in touch with him and pass your information on. Okay, any other questions, anybody?
Kip, thank you for your presentation. This is John Whalen down in Pueblo. Sorry for not introducing myself earlier.
That's all right. I appreciate you saying so.
I enjoy your professionalism and your trend of thought. My question is direct. I recognize that what you have defined can be very confusing to the, I won't say average person, but to a person. So here's my question. How do you define say forward mortgaging versus reverse mortgaging? And as you know, from the past 15 years, there's been a great deal of quote, quote, Hollywood actors pushing reverse mortgages with the definition as it goes that the equity in your contract, using your example of 200,000 with a balance of 100,000 payoff mortgage, they say the equity is your money, and then I see the word HUD, H-U-D, on one of your slides here, and I think about, again, a person saying, why is the government so involved in us or you or anyone else pulling out their equity out of the contract for a reverse mortgage?
Well, the program was designed and initially put out there under Ronald Reagan. And the idea was that,
That's been changed though.
well, what's happened is that originally it was designed so seniors could stay in their home, because the recognition was that most of us were going to go to a fixed income. And if we had mortgages that were not completely paid off and or we had rising expenses, where in the world were we going to get the money to stay in our homes? And the highest percentage of people, when they're interviewed, say that they don't want to go to assisted living. They want to live in their homes until they pass. So the question was, how do we make that happen? Now, back in the 80s, it was the Wild West. I'm not going to lie to you. It was, there were guys making huge amounts of money on every loan because there were no limitations. And where's that money coming from? It's coming from the equity in the house that we're actually trying to access for the benefit of the senior. Well, we have corrected a lot of that, including a spouse not being forced to move out of a house because her or his spouse died, and now they are forced to move. We fixed all of that. The reason this program is critical is that the majority of seniors that are out there, their asset is not tied up in liquidity that they can write a check against or go to their investment counselor. The majority of their asset is tied up in that house. They bought it when it was worth $20,000. They paid off the $20,000 and now it's worth $300,000. But if they take out a mortgage on a 15 or a 30-year mortgage in 60 days, they have to start writing checks to pay the mortgage. And if they miss 90 days of those, it goes into foreclosure. So how do we access the money in that house unless we sell the house? And if we sell the house, then where do you go to live? In Denver, right now, rents are running about $2,000 a month. Well, it doesn't take very long if you've sold your house and you move into $2,000 a month, and that's without any long-term care or any caregivers or anything else. It doesn't take very long for you to run through that equity or the money that you got from selling the house. And then if you outlive the money, then what do you do? So the idea with a reverse mortgage is there's a program that allows you to set up a line of credit or take cash out and still maintain ownership of the house and still be allowed to live in the house regardless of the size of the debt. And the lender then benefits because they're accruing interest on the dollars that you've borrowed, and then those dollars are repaid when you either sell the house or you die and your heirs sell the house. And then when that happens, only that portion that is owed is paid and everything else goes back into your estate. I don't know how any other senior would actually do that. And I'm going to get on my soapbox here for a second. When the state legislature for the last 5 or 6 years has been trying to take away the senior exemption for taxes, and that's not, it's on the first $200,000, but the state legislature is trying to get that removed. And then on top of that, this year, the state legislature went to court, and the courts ruled that we don't have to go before the taxpayers and vote to have our property taxes increased. Now the schools can just tell us how much they're going to increase it, and that's supposed to be okay. And if you're on a fixed income, how in the world are we supposed to keep up with that?
Isn't that on the ballot tonight?
I don't believe so. I think the Supreme Court in Colorado ruled on it earlier this year.
I got a phone call this afternoon from some unidentified individual because they know who I am. Telling
His
me
name wasn't Vito, was it?
my pun. Telling me I should vote tonight and gain 19% income property tax back.
Well, that's on the residential property tax versus the commercial property tax.
Yeah, I'm talking residential.
Yeah, and that's on the ballot tonight. It'll be interesting to see how that goes, because that one's so confusing. I think a lot of people aren't really certain which way they're voting because they don't understand it.
Okay,
Yeah.
folks, we're running over time here.
Okay, well, in any case, the benefit here is that this allows a senior to get the cash they need to stay in their home and maintain their lifestyle without selling the property. That's it.
Thank you.
You're very welcome.
It works.
It does.
Thanks, Meryl.
Thank you, Kip.
Well, thank you, everybody, for being on tonight. I really appreciate it. And for those of you that don't know me, sorry I didn't start off with this, but Chip is out hunting this week. And so I'm using his account, and this is Annette over in District 6. So anyways, I want to thank everybody for coming on tonight. Kip, thank you so much for the information. It was wonderful. Does anybody have anything final to say in closing? It's nice to see you, Lou. There you are.
Good job.
Thank you.
Thank you very much.
You're very welcome.
Okay. And
Thanks, Kip.
Thank you.
so
Appreciate your patience.
Donna F says thank you as well. So, all right, I'm going to go ahead and close the meeting out and shut off the recording, and hopefully we'll see you guys all next Tuesday. Stay
Thanks
safe,
for that.
stay safe,
Thanks for
stay
that.
healthy, and we'll see you soon. Bye-bye.